Hi everyone, this is Michael Benkiat with Lifetime Investor, and this is the Market Trend Advisory Weekend Review video for December 17th, 2022. So let's go ahead and get started right away. So this week we saw a change on Thursday. We went from an uptrend to uptrend uncertain on the major market trend, also known as an uptrend under pressure. When the Fed had its policy meeting on Wednesday, the market didn't like the Fed's hawkish tone, and it just was not what the market was expecting, and it led to another sell-off. If you've been reading our service for a while, you know this wasn't unexpected, and I talked quite a few times about sort of the unfounded optimism the market kept having towards inflation and inflation peaking and interest rates being hikes being reduced and actually turning into interest rate cuts, as soon as next year. I don't think that was something the Fed was not telegraphing, so I don't really know where that came from, but the market got fixed on that, and of course he had to kind of squash that, and we're back now to some more selling in the indexes. So we've had a little bit of damage. The market count has now dropped to 2 out of 5 for the NASDAQ. We're down to 55% exposure. We had what we call a bad break. That's when the market goes down at least 2.25% and closing on the lows and breaking below the 50-day. There's a few parameters for that. We had that as well as breaks below the 50-day and the 21-day. And we've had some additional institutional selling days show up. The S&P's a little bit stronger, though the power trend went under pressure, which knocks the maximum market count down to 5. And then we had another market count sell signal on Friday. So we're down to 4 out of 5 with 90% exposure. And the institutional selling days are now at 4. One more day will actually start triggering a market count sell signal. So the market's not looking as very good. Santa maybe skipping the rally this year, but you never know. We still have 14 more days, 2 weeks to go. Anything can happen. So we'll see. But we're just getting the caution lights. Exposure should be very light, if at all. The one thing we've pointed out for a long time, our individual stocks, non-index ETFs action signal has been red for a long time. We've been showing up to 15% exposure maximum, and that's really been a great signal because overall, despite what the indexers are doing, stocks just are not performing. Leading stocks are just not holding up. They're attempting breakouts, but by and large, most of them are failing. Leading into getting either stopped out or actually complete base failures, which we're seeing a little bit more. So it's just, it's a dangerous environment. It's not one that really you should have much exposure in. And I hope this service has been helping you, just keep your exposure light to non-existent and your powder dry. Because one day a real bull market will come probably out of the blue for most people. But if you're following the service, you'll catch it, and there's going to be some really great opportunities coming up, but we're just not there yet. For our investing strategies, we're still beating the buy and hold for both our QQQ and SPY strategies. Now we've been using our market count 1 strategy, which is really just using the QQQ or SPY, no leverage. If you look on our big spreadsheet on our service, you'll see that using any kind of leverage is really leading to poor returns. I think with the TQQQ, if you'd just been trading that this year, you'd be down over 40%. Unacceptable, which is why we don't use that, though we do track it. So we're down on 16.25%. Of course, the QQQ itself, buy and hold, is down over 30%, so better. But it's been a very tricky year. For holding any kind of exposure for a long time. But that's where it is, and I think that will improve rapidly once the market ends up bottoming out. Okay, let's take a look at the indexes as we usually do. So the Dow has definitely been the strongest. We had some very powerful action in October, just really a lot of strong updates. We got a little bit of resistance at the 200-day. That's this black line right here, but it came blasting out of there. But we did have a big reversal last week. A little bit too much enthusiasm in the indexes, given what was going on with interest rates and the CPI and the PPI. And of course, now we're reversing that. But we're still holding above the 50-day, which is in a nice uptrend, and the 200-day. But it wouldn't be surprising for this to fail because the other indexes are not holding. So let's take a look at the S&P. We've seen pretty much every time we've got up to the 200, it was not able to hold. It's the black line again. And even though we've had a few times we were above it for a week or so, maybe 8-9 days. Here we didn't. We got right to it, came back down. Here we got above it a couple days, 3 days, and that was about it. Now we're actually below the 50-day, and it's looking more like 3,500 is looking to be a target. We also had a very high volume because we had the quadruple witching on Friday. Now the NASDAQ is definitely the weakest. You can just see that we never went as far up. We never even got to the 200-day. We're farther below the 50-day. And as I wrote on Friday, we're just a little above 600 points away from new lows, new bear market lows. In this volatile environment, that could just be one day. So unlikely, but we could just see another few days down and we'll make new lows. So it's not looking good. As we know, the big mega caps have been really underperforming or performing pretty poorly. And that doesn't seem to be changing anytime soon. And finally, the Russell, the small caps, same thing. You can see just can never get above the 200. And what is that telling us? That the 200 is where institutions have just been unloading stock. They will wait till it gets up close there, and then they've been unloading positions. Now, you remember a lot of these positions are probably things that have been built up over years, and they just realize it's not the time to be putting on big positions, but to exit and taking profits or losses in some of their positions. Here we had much more volatility around the 200, but just really couldn't hold. We only had a few days above it, and now we've broken down. Though we saw a little bit of strength on Friday. You can see how it closed near its high. But really nothing to really get excited about in any of this. So let's move on to the technicals. You can see we're we had run up to almost 50% of stocks above the 200-day moving average, which seemed a little excessive because it happened so quickly. And now we're just starting to drop down. We're starting to get a little more, orange and a little bit of tinge of red again coming in here. So this is not acting very well. One thing that's been a little concerning too is the 52-week lows have been swamping 52-week highs almost continuously for months now, except for a day here or there. You can even see in the ratio, just really poor. Here we had one day where the highs were above. These were equal here. Just not very, very strong. The NASDAQ percent above the 50-day, we've dropped below it again. We were actually, 5% or so above it, not acting very well. The number of stocks that have broken out, we had just about a month ago, a little bit longer, we were up in the 80s. It really had a huge jump up, but just as quickly came right back down, and now we're turning back into the red. And then finally, we see the down volume just, you just don't see a lot of green. And the days where you have really powerful up days like here, there was no follow through. They just see the next few days was really not much, and then we went back into down volume swamping. So the technicals really just not painting a picture of any strength in the market under the surface. So, which is sometimes we like to see that kind of divergence. We're just not seeing it. Here's a chart that we don't show very often, and it's just showing various indexes, whether or not they're above their 200s, 50-day moving averages, and if they're aligned. Ultimately, when you're in a nice uptrend, you're going to see the alignment of the moving averages. The 200 is going to be below the 150, which will be below the 50, and above that will be the 21. We haven't seen that in a long time. And we did have a little pockets of strength. The Russell 2000 had got above the 50-day, as well as the S&P 400, which is the mid caps. But as of Friday, everything turned below. Really not a lot of strength there either. And then finally with sentiment, we can just see from the VIX, it's been solid red for this whole year, just showing that the volatility has just been accelerated and holding strong this whole year. This normally should be, in the yellows, maybe some orange, and down to the greens when you get down to, below 15, 13, 12, when it starts getting, low volatility. We've seen none of that. This has also been a warning sign for this whole year of that it was not going to be a strong up year. We also saw very quickly the CNN fear greed indicator went back up to greed. Now we've actually shot down to fear again. We've seen a few days here in the put call above 1 showing some fear, but just not enough fear. And same with the investors intelligence weekly bulls. We've started to see almost like a creep up to neutral overall to actually a little bit bullish. And it's starting to change a little bit, but we're definitely nowhere near that kind of black sentiment that has at least moved, pointed out to oversold rallies or just, contrary rallies. So we're not seeing that. So we're just not getting a lot of strength. So I think at this point, I think the path of least resistance is down. It wouldn't be surprising to see new lows appear in the indexes. And we're just not there with the other indicators pointing to any kind of reversal. That's where we are. So I just want to do a really quick recap here about what's been going on. Probably this is no news to anybody who's reading this, but for anybody that's new, we got another sell-off this week because the market is really all it's concerned about is the outlook of interest rates and the economy and whether we're going into a recession and what the Fed's policy is. And the market got really overly ambitious, overly optimistic about what was happening. They were kind of ignoring what the Fed was actually doing and saying. That worked in the past because the Fed was more likely, going back over a decade ago, the Fed was more likely to just cave to pressure, which it did like in 2018. But Powell, I got to give him credit. He's really been holding strong that, he's like the economy is going to unfortunately have to take some strong medicine to get better and get rid of inflation, which is what most of the Fed presidents were unwilling to do. So anyways, on Wednesday, his hawkish tone really just didn't sit well with the market, and it added to worries that they're going to be hiking for longer and farther and deeper. And then we had a batch of disappointing economic data that came out, and really just the market is just not happy with what's going on. So now, while we do see that inflation is showing some signs of slowing, but the Fed is just continues to signal that it plans to raise interest rates into next year, and there's really no rate cuts expected all next year. And they're really won't be considering anything until they're confident that inflation is coming down in a sustained way. And remember, the Fed's target is 2%, but they've been raising their sort of terminal rate to above 5. So there were quite a big difference between what's going on there. So it doesn't look like, I think that's what the market's reacting now. Not only won't be any rate cuts, it doesn't look like he's even going to pause anytime soon. And that is causing the market some a conniption fit, if you want to call it. So just a quick thing on the bear markets and recessions. Of course, we're still in a downtrend. You can see it in the moving averages pointing downwards and the trend of the market. So we're in a bear market also. Now, one thing is that the bear markets have never ended before the start of a recession. So a recession is going to likely mean new lows in the averages, and that a recession is coming is almost certain. So, of course, the stock market is a discounting mechanism, and it's always discounting and then rallies before the economy comes out of a recession. You'll see that all the time. A lot of times when the news is worse, and you think, here we go, another leg down, and the market starts rallying because it's already discounted that news. So in this case, the market tends to discount and rally coming out of recession by an average of about 4 months. And a typical recession bear market is about 1.5 years. We're about a year into it. And there's also the typical bear market has a median drawdown of 38%. So this is going to imply that the market's going to bottom around the middle of next year with the S&P probably around 3,000, which is a pretty still steep drop to go. We also have a few things that, earnings estimates are coming down. A lot of analysts don't feel like the market's priced any of that in. It's almost as if they got earnings growth happening across the market. Looks highly unlikely in this environment. So to see it come down to there is probably likely. But the lower it goes, the better the situation will be when the market turns around. And we saw that, of course, in 2000 when it finally bottomed in 2003. And then, of course, in 2009 in March when the market bottomed. Fantastic buying opportunities. And just finally, next week, we'll probably get some more fireworks. We're going to see the PCE report. That's the personal income and spending. That's said to be the Fed's preferred measure of inflation. And so if that comes down substantially, we might see another massive rally. But at the same time, the market knows that, Powell keeps saying that they're going to need substantially more evidence that inflation is on a sustained downtrend before it really changes its policy. But this is an important one because it's one the Fed keeps a close eye on, really more than the CPI and PPI, which are a little bit wider, but I think not as current indicators as the other ones. So that's about it for this week. We're mostly keeping our powder dry. There's not a lot to do. Leading stocks are just not acting well. In our stock picks service, we just have one small position and really just not a lot setting up. It's just not, unfortunately, a good environment for stocks at this point. But I must say that, do keep engaged. It's easy to just say, nothing's going on, I'm going to walk away. Because the market can turn and does turn frequently, very quickly, and you don't want to miss out on the turn. And when the market does finally turn into an excellent buying opportunity with fast gains, it will happen. So I just say, keep engaged in the market. It will reward you at some time in the future. Okay, thanks a lot. Talk to you next week.